Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, the energy markets, oil and gas. Traders are getting jittery as the situation in Syria looks more and more unstable. And that's not to mention the ongoing tensions in Egypt and Libya and Iran. Are we in for another bumpy ride on the world's energy markets? And to that end, is something like shale gas the answer to the world's energy problems? Some estimates suggest the United States could be sitting on the gas equivalent of 1 trillion barrels of oil. Perhaps a shale gas revolution is on the way. And just what is the attraction with European property for Middle Eastern investors? They're buying more and more. We speak to the authors of a new report to find out why. So you know how the story goes. When there's the threat of trouble in the Middle East, the price of oil starts to climb. Simple as that. And so it was again. US oil prices hit a 2-year high midweek as traders worried about what was looking like the ever more probable chance of military action against Syria. And so this week we're looking at not just the politics of oil, but the geopolitics of it. Have a look at this first of all. The Middle East accounted for 35% of global oil output in just the first quarter of this year, according to the International Energy Agency. So obviously, any potential disruption to that supply has the market worried. But it isn't quite as black and white as you might think. You go back to May 2011 when NATO went into action against the Libyan leader, Muammar Gaddafi. US oil prices actually fell almost 10% when that happened. As it was the same 10 years ago when the US-led coalition invaded Iraq. Oil futures tumbled 15% back then. The short story being, prices rose on the fear and then settled when the actual battles commenced. But then look at what's happening now. US oil stockpiles are up, increasing by the most in 4 months. In fact, there are now 362 million barrels of crude sitting in tanks as a backup in case supplies are interrupted. Now, just to illustrate our geopolitical point here, Syria itself doesn't really export oil, not in any great amounts at least. It's the opposite of those previous conflicts we mentioned, Libya and Iraq, where there was a real threat of oil disruption to the rest of the world. In fact, Syrian oil is more important to the Syrian economy than anywhere else. Back in 2010, when it was still a functioning economy, oil exports, they were modest, but they still pulled in $3.2 billion, accounting for 25% of state revenue. But let's get into all this geopolitics then. The perfect person to do that with is Dr. Mamdouh Salameh. 30 years in the business now. He is director of the Oil Market Consultancy Service, which is based in the United Kingdom. And we thank you for your time, Dr. Salameh. What do you make of what's happening at the moment? The threat, the likelihood of increased conflict in Syria. How bad do you think the impact could be on the oil markets?
Well, as you know, I have coined a phrase about oil, which I say oil is like a coin. One side is economics and the other side is geopolitics. Against this theory, we find that the global oil market and the price of oil are very susceptible to any political developments. So when there is a threat of attack on Syria, of course, the global oil market becomes very sensitive, and that is reflected in a rise in the oil price, and we have seen that happening in the last 2 days with the price going to $116, $117 a barrel. The threat is that the oil market is always nervous about this because they believe that an expansion of the attack on Syria could drag some other oil producers like Iran, Saudi Arabia, Qatar, and Russia. That's why the market is in a frenzy, and I project that the oil price could hit $120 to $125, depending on the size of the attack and the duration.
So in effect, it's not about Syria really, is it about everyone else? Because, you know, as you know, this isn't Iraq, it isn't Libya, where you're looking at actual oil supplies potentially being affected. It's the fact that they could be drawn in, and even that's not certain.
That's very true. Syria is a very minor oil producer. They produce or used to produce around 400,000 barrels a day. But the question is, there are many countries involved in the civil war in Syria, and these are major oil producers like Iran, Saudi Arabia, Qatar, and politically Russia. All of them are major oil producers, so the talk of the attack affects the global oil market and the global oil price, and not Syrian oil alone.
As a result of all of this, Dr. Salome, we see things like stockpiling. We are seeing a lot of that in the United States at the moment. Is that effective? Does it work in these times to regulate the price of, and not just the price, because I guess the knock-on effect is the price of petrol as well, but does it have a marked effect on prices?
Well, when the price of oil goes up, automatically it affects the global oil market and the global economy. And of course, in this case, I have calculated that every $10 rise in the price of oil cuts half a percentage point from the growth in the global economy. So of course, any rise in the oil price affects the global economy, but as I said before, it depends on the duration of the attack and the size of the attack. If the attack is very limited, of course, the rise in the oil price will be short-lived. But if it is an extended attack, then we can see that it will drag some other countries, and that's where the crux of the matter is.
Looking beyond the Syrian conflict to the wider Middle East, do you actually see any more troubling areas? Again, thinking of the actual oil producers, the Libyas and the Iraqs, which we mentioned, because there's still a lot of uncertainty in both of those countries, and they could easily pose more problems to oil supplies as well.
Well, before I answer this point, may I mention that any Western intervention anywhere has been a failure. Take the case of Iraq. They attacked Iraq, and Iraq is the oil giant of oil in the 21st century if the infrastructure and politics permits it. Where is Iraq now? It is not even producing enough to the level that it was under the sanctions under Saddam Hussein. And look at the chaos in Iraq now. And look at Libya. After the intervention, the production of oil has declined, and of course the exports. And where are we now in Libya? Libya's production is at least 50% less than it was before the conflict. They used to produce around 1.6 million barrels a day, from which they export 1.25 million barrels a day. Now they are not even producing 1 million, and therefore their exports are less than 400 to 500,000. So you can see Saudi Arabia, of course, can supply any decline, or the Gulf states, Kuwait, UAE, Qatar, and Saudi, and Russia can supply the difference. But there is a limit even to how much Saudi Arabia can increase its oil production. There is a limit beyond which they cannot go.
Okay, just a final thought then, Dr. Salome, because pretty much everything we've talked about has been quite negative so far. What's on the flip side? Who stands to benefit from all of this?
Of course, when the oil price goes up, the benefit, it benefits the producers, Russia and the Gulf producers and Iran, the major producers. But there will be a net loss as usual, because the whole global economy will be affected, and that retards any potential growth in the global economy. So in a way, there is a net loss no matter how the price goes up and how much benefit the producers get. The final loss is for affecting the global economy.
Dr. Mamdouh Salome, an absolute expert on oil, joining us for Counting the Cost this week. Thank you for your time. And still ahead on Counting the Cost, the money pouring into European property from the Middle East, why it's only increasing and what it's doing to the market a little later on. Now, we were talking about the impact of geopolitics on the oil markets. What we want to look at now is what could possibly offset some of that volatility. For that, we look to North America, where experts say a boom in oil production may help to moderate those shocks. The proof, they say, is in the price fluctuations, which are now half what they were early last decade. Have a look at this now from Tom Ackerman.
It's midday in the once sleepy center of Nixon, Texas. Not so long ago, this was a quiet farming town. Now it's a literal crossroad of the oil and gas drilling boom in South Texas. That boom has been good for the family restaurant run by Daisy Barajas. She's one of many people who've been drawn to an area where Spanish is heard nearly as often as English.
Pues a nosotros ahorita nos ha beneficiado bastante.
We've benefited quite a bit because we have a lot of oil companies and they've helped us, as well as other businesses in Nixon. A lot of people are moving here from all over Texas.
It's been more than a century since Texas saw its first oil gusher, making America the world's leading producer until it was eclipsed by the Middle East. But with new hydraulic fracturing technology, drillers are exploiting the state's deep shale oil and gas deposits as never before.
In just the past 3 years, Texas has doubled its crude production, a sharp reversal from 2 decades of falling output. If it were considered an independent nation, Texas would rank just behind Kuwait and Venezuela on the global list of oil-producing states.
It's a big reason that Texas was able to escape the worst of the Great Recession. While U.S. jobs grew only by 1% in the last 5 years, the oil and gas industry increased by 40%. Those paychecks are nourishing the local economy in one of the historically poorest regions of the country.
All of a sudden, you're seeing jobs in South Texas that are averaging $70,000, $80,000 a year, plus benefits, and the region just has not seen that kind of multiplier effect. It will change South Texas.
After previous oil booms, Texas has gone through busts. But as America's thirst for fossil fuel keeps growing and crude oil prices stay firm, people here expect a long ride.
But in the energy world, we've been hearing a lot about shale gas lately, particularly the protests against its extraction. Scenes like these in Argentina, 3,000 demonstrators fighting with riot police in front of a Congress building, angry about a proposed deal between a state-run oil company and the US energy giant Chevron. Critics say the government isn't being honest about the environmental risks of shale gas exploration. But it's interesting it gets so much publicity now because shale gas actually has a much longer history as an energy source than you may think. It was way back in 1821 that shale gas was first extracted. That was in the town of Fredonia in New York State. But it was in 1947 that process of fracking, which we hear so much about, well, that was when it was first developed. That's when rocks containing the gas are blasted apart with high-pressure liquid. In the 1970s, it became bigger business when the US saw the first industrial-scale extraction of shale gas. What we want to find out, though, was whether this has got any legs, whether shale gas is as important as it's often described. And we're going to do that with Cornelia Meyer. She's an independent energy expert and the CEO of the MLR Corporation, joining us from Geneva this week. Cornelia, thank you for your time. A word I often hear used these days with shale gas is revolution, and I wonder how accurate that is. Is it overstating it, or is it really a big deal?
I would say for the United States, it certainly is that big a deal, because if you look at how this very reasonably priced shale gas has revolutionized industry and made U.S. industry competitive again, that's absolutely true. For the rest of the world, not so much.
So what then is the potential it could have on the energy markets? Oil, of course, being the traditional energy market, the first stop really when we talk about energy, rightly or wrongly. But I wonder how much of an impact do you think shale gas can have on the dynamics of those oil markets?
Well, it has a big impact in terms of trade flows. If you look at how much energy we'll need, primary energy demand over the next 20 years will go up by 50%. So we really need every barrel, every solar panel, every gallon that we can get. But what happens is that a lot of the oil that traditionally was destined for the United States, like for instance Nigeria, Bonny Light, or other such crudes, are now no longer going to the United States. They're going instead to Asia and to Europe. So what we see is just a rearranging of trade flows.
A rearranging. Okay, so not enough to tip any balance in any particular way, do you think?
Well, I would say it has a short-term impact on the balance, and certainly in the U.S. I mean, gas has become very cheap, and it's actually cheaper than production cost, and that's a problem. But in terms of globally, no, not to tip a balance, because again, we have to keep that against the growing demand from mainly emerging markets, the Chinas, the Indias, what we call the next 11s, the Turkish, the Indonesias, who are just so hungry for oil. And they will need all the oil they can get their hands on. So the oil from places like Nigeria, instead of going to the US now, is going to Asia. Same for LNG from Qatar.
Cornelia, tell me your thoughts on the more controversial side of things. I said earlier that we always hear the word revolution used in association with shale gas. The other word, of course, is fracking. This controversy that goes with it. What do you make of it? Again, is that slightly overblown, or are there real concerns over fracking?
I mean, I think it's slightly overblown. And if you look at it in the United States, it's not that much of a problem, but mainly because the people who own the land also own the minerals underground. So they own the oil or the gas underground. So if they have an environmental problem, the monetary rewards are big enough that they can move somewhere else, so they're not too bothered. That's a little bit different in places like Europe, where, the oil or the minerals in the ground are owned by the state. So the environmental concerns become bigger because people are less financially incentivized.
And as an extension of that, how do the costs compare? When you look at the cost of dragging oil out of the ground, how does it compare to the fracking process, which brings the shale gas to the surface?
Well, shale is a little bit more expensive, but if you compare it from the US, again, to newer markets, the costs in newer markets are much higher. The reason being is in the US, you have so many rigs and so much fracking equipment and so many specialized qualified staff who can get the oil and the gas out of the shale, that the production becomes cheaper. Whereas in Europe or also in China, there's just not enough rigs. There's not enough fracking equipment. And as with everything, when you have a lot more demand than supply, the prices go up.
Okay, can I just get a final thought from you, Cornelia? And this is more to do with the fact that we broadcast this program internationally, and really you and I have spoken mostly about the US so far. Who else really stands to benefit? Where are the other pockets in the world where this shale gas revolution could be?
Well, the biggest pocket is probably in terms of geology is China. But then you have parts of Europe like Poland, England, and so on. But we have to look at what makes that shale revolution in the US so successful. It's a few factors. It's, again, the incentivization of the people who own the land, because they also own the minerals. It's a very, very good infrastructure of pipelines. It is the access to the fracking equipment, and it is risk capital that goes to junior companies. This shale revolution didn't start with the big companies. It started with smaller companies who are willing to take risk capital. In that sense, the UK is probably in the short run the closest to being close to a solution, because it has a deregulated market. It has a good pipeline infrastructure with the aim. It has a stock market that for smaller junior companies which are willing to take risk capital. It doesn't have the equipment as we discussed before. China will address the issue just because she is so hungry for energy.
Cornelia Meyer, it's been a pleasure talking today. Thank you so much for joining us on Counting the Cost.
Thank you very much.
Just something different to finish off on this week. If you thought, anecdotally at least, that a lot of prime European property was ending up in the hands of Middle East investors these days, well, here's the facts to back you up. A new report out from the international commercial real estate company CBRE, which has shown that in the first half of this year, buyers from the Middle East accounted for 9% of the entire market, with 25% now coming from anywhere outside of Europe. London remains the hot spot. Nearly 50% of all property investments by Middle Eastern buyers are in the British capital, which kind of tallies up with the last few years. You know, there's been some real landmark British properties snapped up. Qatar's sovereign wealth fund bought up the famous Harrods department store and is also the financing behind what is now the tallest building in Europe on the left of your picture there, the Shard in London. Let's talk to the people behind the report. Nick McLean is joining us from Dubai. He is the Managing Director of CBRE Middle East. And Nick, what always interests me is that places like, Dubai, Abu Dhabi, Doha, they're all building iconic cities of their own. The evidence is behind you there. So why this obsession with getting into the European markets to such an extent?
I think there's always been an interest in some of the overseas markets, and it's the right thing to do. There's such opportunity within the Middle Eastern cities that major investors have got a very significant stake in the markets at home. But any portfolio around the world is diverse, and therefore looking for other markets which can balance some of the opportunities which exist here is appealing both to institutions, to the sovereign wealth funds and to individual investors.
And it always seems to be, though I'm sure there is more to it than this, but there always seems to be a lean towards the big ticket items, the Harrods and the Chelsea barracks and the like, even building projects of their own like the Shard in London, which we mentioned. It seems these are the desired things, the big label items, let's call it that.
Yeah, I think the difference between some of the large Middle Eastern investors is that they have access to a lot of equity, a lot of cash, and therefore they can differentiate themselves and give them an advantage in the chase for some of these assets because of the scale. So the number of people who compete at the very large scale, more than 500 million euros, for instance, is relatively limited. And therefore, if the sovereigns are interested to put money into these marketplaces, they give themselves a competitive advantage by going to these larger assets.
Do you know how all of this gets received in Europe, Nick? I'm guessing, given all the economic problems there are in Europe, that they'd be happy for any sort of, cash injections which come their way. Exactly. Is it now accepted that this is just part of life, that large amounts of important property have overseas owners, particularly from the Middle East?
Yeah, Middle Eastern money has always been very welcome in London. I think my office, CBRE, here in the region, we host a lot of people coming from all around the world who want to gain access to the capital flows which come from Qatar or from the UAE or increasingly from Kuwait and Saudi. And therefore, there's an enthusiasm to have partnership through funding in their home markets, whether they be Europe or the Far East or the US. But it's not all one-way traffic. There's an increasing number of people who are interested to invest into Middle Eastern markets too. And that's, again, to balance some of the global portfolios that people have.
Right. I should point out, Nick, and even though we've been focusing a lot on the Middle East, and obviously you and I know this part of the world very well, it's actually North American investors who are buying up the most European property. Again, how is that happening? Because you think of the United States being a bit like Europe, still not a great place economically speaking, and yet they're buying up property.
Yes. Yeah. There are certain parts of the US which are extremely attractive to all sorts of investors. But again, diversification is key, and balancing a portfolio geographically is quite important. And that's why I think we see an increase, there's a proportional increase in the people from the Far East Asia Pac location coming into European properties, which is not historically where they've been before. So it's not just a question of North American, particularly US and Middle Eastern investors increasing their stakes. There are all sorts of locations for people to come. And one of the reasons why they like the European markets is the liquidity. So for instance, if you enter one of those markets and you want to exit, you can do that pretty easily because the markets are transparent and there's significant demand. And they're also showing very good returns at the moment.
Is there a bit of status involved as well, I wonder? A lot of these European cities, they have so much history, they've got these locations of importance. Maybe there's a bit of status involved in this.
Yes, for some investors there's status, but I think also there's comfort and familiarity. If you look at the numbers of visitors from the Middle East going to European cities, especially London at the moment, then people from the Middle East spend a large proportion of their lives there. They feel comfortable in those cities, and those who are responsible for investment therefore want to invest into that infrastructure or the state of those cities. So I think it's partly comfort, partly history, yes. No one investor, no two investors are the same. So some invest purely for the returns, and the returns, as I said earlier, in London at the moment seem to be particularly good.
Yes, certainly is. Nick McLean from CBRE talking Euro property with us this week. Thank you very much, Nick.
Thank you.
And that's our show for this week, but there is more for you online at aljazeera.com/business. The latest business headlines are there, as well as all of our previous episodes for you to catch up on whenever you'd like. And then to get in touch, you can tweet either me at Kamal AJE, our business editor at Abid Oliver Ali, or drop us an email, counting the cost at aljazeera.net is the address. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria. From the whole team, thanks for joining us. The news on Al Jazeera is next.